Okay, so good morning, everyone. Again, thanks for spending your very precious Saturday and even morning and even your precious afternoon with us. So today we'll just discuss about our Singapore strategy and especially like to thank all our Phillip and Poem customers for all their support and their attendance here today. So we really thank you for that. So I'm just going to start. So on the first slide, again, we issued a report on the third quarter strategy. We tried to condense it, so not to make it too many pages, because these days not many people like to read thick reports. So basically, the title of our strategy was responding with overwhelming force. It basically refers to the overwhelming response that we're getting from the central banks and governments. And okay, the picture here doesn't mean that Singapore is being struck by lightning, or July 10 is coming. There's anything about lightning that we're supporting or not supporting. Okay, it's just a reflection. The picture is just to show the only picture I could find on overwhelming force. Okay, so anyway, let's move on. Okay, this is our disclaimer page. I know a lot of words here. I know most won't really read it, but I think it's just for us to. So I'm just trying to briefly explain. This is just our views. The disclaimer, the first paragraph. The second paragraph is just to let everyone know that we take information from publicly available information, and we can't really verify the accuracy of this information. But again, it's all public information. And again, the third line is just to say that our recommendations, doesn't take into account each individual's objectives and so forth. And again, seek your financial advisor if you want to know more whether it's suitable for you. Okay, so that's it for the boring part. Okay, this is our agenda. I will first let's go through the second quarter performance. Then very quickly run through the economic conditions. Then we'll just run through the plus and minuses in terms of the themes and what's helping the market and what's not helping the market. Our technical chartist, Viren, will go through just a update on how he sees the Singapore STI and his one favorite stock pick. And also we have sector views by all the analysts who are here today. And then we have our stock picks. We cover lots of stocks, but we're just going to narrow it to our 10 stocks that is under our Phillip 10 so-called model portfolio. And just a one slide on the conclusions, and then we will have the usual Q&A for everyone to ask questions. Okay, just a quick review of the market. So this is just a quick snapshot. We're just looking back at what has happened to the market. So if you can see that STI is the red line. So this is on the first half, so which is January to June of this year. We didn't do well. I mean, probably this is not the best slide to start off with if you're trying to promote the STI market. As you can see, we are in red, and we are the red bar, and the orange bar is the REIT. So you can see that actually the REIT has actually outperformed us in almost the past 3.5 years, almost every year. REITs have outperformed the STI. You can see that this is the REIT, the beige line keeps on outperforming. It did outperform us in 17, 18, and also 19, and also this year. And if you look at the past 3 years, what has done well is actually the MSCI Asia ex Japan. For those who do not know, most regional funds, maybe if you're a US fund manager who wants to invest into Asia, so this is typically the index that they will buy, which is the MSCI Asia ex Japan. And inside this, it's basically investing in the whole of Asia, excluding Japan. And some of the top holdings, as you can see, is Alibaba, Tencent. So you can see that this blue line is very tech heavy. So, and this tech heavy, of course, is a bit higher beta, more volatility. So like 2018, they lost more. But just to show you, just to have a quick look at how the STI performed, at least the last 3.5 years. So anyway, if we move on to the second quarter performance in terms of the STI components, in the second quarter, the STI was up at around 4%. And what we see is that what has done well, of course, the banks, and actually driving all the performance for, the banks take out almost 40% of the STI. So driving the performance in the second quarter, at least, has been actually DBS. I think if DBS didn't pull the whole STI, will be, I think, be a bit of a trouble in terms of the performance. The other banks just perform in line at 4%. What did well were some of the cyclicals like Wilmar, Venture. Wilmar, of course, you had the IPO. And of course, the consumer also recovered, but not all, like dairy farm, probably the structural issues there too. Some of the worst performers were the notable names like SATS, the transport related. SGX, after doing performed very well in the first quarter, I think gave up some of the returns. And also you don't see the continuation, but some of the ones that performed weak that were also down about 9-8% was like your SIA Comfort. So the transportation sector was continuing to be pressed down. The property actually, although they rebounded, they're still in a net loss for this year. And of course, REITs outperform again. I think you can see some of the big performers, Mapletree, Logistic Trust, Ascender, CCT, they still outperform the index, which was only up about 4%. Again, this slide is just for reference. I mean, don't take too much into it, but it's just for everyone's reference that the GDP, the country's GDP does not really correlate exactly to the STI. So there could be years where let's say you look at this, the GDP was up about 2%, but the market can go down 50%. Likewise, it can be only flat, but it can again, the market moves on expectations and so forth. And of course, this year, for 2020, expectations is for contraction of 4 to 6%. So you can see this GDP, we never had a 4 to 6%. So this is probably going to be the worst that Singapore has experienced. Okay, I'll move on to the next slide. Okay, sorry, my internet connection. Okay, not much of a presentation. Are we in a recession? But anyway, that was before COVID, obviously. So, and this chart, the bad news is that this is from IMF data. So, from the world GDP is expected to contract about 5%. So, globally, we are in a recession. But the good news is that if there's a good news that is already priced in. So no one's going to ask you that are we in a recession? It's already in, we're already priced in. So the market expectations is already that the global economy is already weak. So it's unlike a few years, like a year ago, everyone's so worried that there'll be an upcoming recession. So this time around, a recession has already been priced in by the market. Okay, if we move on, this is just a look at global manufacturing activity. Like we mentioned before, this is a survey. So we can see there's a V-shaped rebound. Obviously, it's still below 50, where you can say it's still contracting mode, but we can see that there's a big recovery, at least globally, in terms of manufacturing activity, because this is a survey. So if you move on to this data, so this is Google mobility trends. They only released it this year. So prior to that, they don't disclose such numbers. So this is just to have a quick reflection of the activity that is happening in Singapore. So the blue line here is basically the retail activity. That means people going to malls, recreation. The red line is basically people moving into offices, going back to office and so forth. The interesting thing, or maybe even the scary thing, is that they actually track what we are doing. More worrying, of course, if for night activity. But anyway, if you move on to this, you can see that when we hit the circuit breaker, which is the shaded line here, you obviously see there's a big contraction in activity. And then as we move on to the relaxation of phase one, you can see activity start to perk up again. And then phase two, you can see activity perking up. Of course, the key part we want to see is that whether it goes back to zero, which is where this is like the pre-COVID levels. It's not, but it's good that that activity is returning back into Singapore, and this is one way we actually can track daily. Okay. Likewise, Apple also released the mobility not only for Singapore. The links are at the bottom. If you want to, there's a huge Excel sheet there where you have all the data. So this is more from driving and activity in MRTs. Again, it's a similar activity. So it's a positive at least that we see that activity is coming back into Singapore, and it's not normal back to the pre-COVID, but at least it's improving. So that's a positive, at least for our Singapore economy. Okay, and of course we just have a quick look at the US. I don't want to delve too much on the economic data because it's more or less tracking what the earlier chart, the PMI data was. So if you look at just the mobility in the US, things are also improving. As you can see, things are picking up. Again, this is again driving activity, retail, and everything. So picking up. So these are basically good signs that the economy is gradually healing, and we do not want the contraction to continue like we had early March when COVID started to occur. Okay, anyway, like I said, economic data, we don't want to delve too much because that's in the past. But anyway, let's want to move on more on some of the plus and minuses that we see in the market. Why some of the favorable things that's happening for the equity market. Okay, anyway, okay, this chart is a bit there's a lot of data here, so don't worry, I'll guide you through. So the first plus we have for the equity market is that we are having a huge monetary stimulus. So just to give you some context or let you understand how large this is. As we all know, we had QE1. Again, for those who do not understand, QE1 basically is like the central bank. You can assume it's like MES going into the market and buying Singapore government bonds to support to keep interest rates low and to push investors in a way to riskier assets. So you can see that in QE1, after the global financial crisis, they acquired almost 300 billion. Then the economy slowed down a bit. Then they started to do QE2, which is even larger, which is about 900 billion over 12 months. Then QE3 or 300. Then, as some of you, if you have followed the market, you can recall there was a bit of sell down sometime here when they wanted to. There was a bit of tapering. They wanted to, instead of buying, they wanted to sell some of the bonds, so they sold a little bit. And then you can see right now we are in QE infinite in terms that the Federal Reserve has so far bought almost 3 trillion over the past 12 months of government bonds. So this is important because it shows that they want to keep interest rates low, and also they want to push everyone into riskier assets, and they're even buying corporate bonds. So they're trying to push investors to buy the riskier, because at 0%, investors are or 0.7, 0.8, the investors are not earning anything on their government bonds, and that's why the significance of this. We added this red line. Again, it may be a bit boring for some, but this red line basically is the amount of debt that the US government is issuing. So almost 70% of all the debt that's being issued by the US government is being bought by the Federal Reserve, which is unprecedented. So what it means is that the central bank is the so-called helicopter money situation, where the government is actually they are actually printing a lot more money because they are actually being funded by the central bank themselves. And just to re-emphasize, if those who want to question how committed the Federal Reserve is, so they said that they will purchase treasuries and mortgage-backed securities in amounts needed. That means basically unlimited amounts of purchasing will be done. Yeah, like what Draghi said, in whatever it takes. So in that sense, so we're getting a lot of monetary easing by the authorities in US at least. And just to re-emphasize that they are not going to raise rates. So for those who do not know, the Federal Reserve or the FOMC, they come up with a dot plot. That means they will have a survey among all the governors, those in the Federal Reserve, the FOMC at least, to see what is their outlook for interest rates. So this comes out this is exact snapshot of that report. So you can see all these little dots are the views of all the members. So what they're saying is that they don't expect rates to be unchanged even until 2022. I do not know who are these two guys here. Probably they are the most unpopular ones on the board. But anyway, so these are so in general, we can expect rates not to be unchanged at least the next 2.5 years. And just to re-emphasize that they are not going to raise rates. This didn't come from me. This came from the chairman, that he just said that we are not even thinking about raising interest rates. So you can't even make this up anyway. But this is what he says. I mean, he's not even thinking of even thinking. So just to reinforce that there is no interest. They have no plans to raise interest rates at least the next 2.5 years. This was a quote from their press conference. So that's the positive that we had. And as a result of Federal Reserve basically is like the world central bank. So as a result of that, what we've seen is that globally all interest rates are at record lows. So you can see the beige line here. This Germany, this is the zero line. So it went negative even before 2016, late 2016, and continues to be negative 0.45. So again, in the Singapore is 0.9. All these are record low rates for us. And in the US is 0.73, again, a record low interest rates. And of course, we just want to quote from a report, we find no intrinsic value in government bonds except as a hedge. So, I mean, if you really, actually this came from a report, so this is like free advertising. But anyway, what we're trying to say is that if you really think hard, at 0.7%, there's really no value in government bonds, except for you to hit, and this is over 10 years. So you're getting less than 1% for the next 10 years. So as a hedge, so people will park money into government bonds when they're worried that the market sell down. So apart from that, there's really no real value in government bonds. These bullet points is just to remind everyone why low interest rates is important. So when you have low interest rates, it acts as a growth stimulus, so it can help stimulate the economy. Secondly, it will be positive for the asset prices, because when you have, especially as we have all seen how real estate prices have moved. So, and also the third reason is that it will also make equity prices attractive relative to bonds. So all these are positives for equity. And what it also means is that if you have an asset or equity that gives you good yield, it will become more and more valuable, at least in our opinion, because as you can see, rates will continue to fall or at least stay at record levels. So dividend yield is, as we will emphasize later, is a core part of our equity strategy. Okay, anyway, if you want to look at what's happening in Singapore, at least for liquidity and all this monetary easing. So what you can see, the blue line is actually the foreign reserves. So you can see that our foreign reserves, we always had very good foreign reserves, 100 billion, then 200, but we've actually recently, I think last month, we hit 300 billion. So these are record levels for Singapore. In the past, we are hitting, the past 5 months, we received about 21.5 billion US. So there's a lot of liquidity outside. I do not know who this, don't ask me where's the source of these flows, but the flows is coming at record levels. So our reserves are now about 300 billion. And if you look at the domestic liquidity, just look at the deposits in Singapore, which is the red line. Again, record levels again. And what it also means, because our loans growth later, our banking analysts will explain, there's really no loans growth. There's almost hardly any loans growth. So what it means is also that there's a lot of liquidity being hoarded right now. Maybe there's a lot of fear and there's a lot of cash being hoarded in the Singapore banking system. As you can see from here, this is basically just for reference. The amount of deposits increases every year. So we're hitting 52 billion. It's probably going to be a record level because it's only been the past 5 months. So there's a lot of liquidity being stashed everywhere, probably because of everyone's fearful of the environment right now. Okay, if you so that was the first plus. So we're positive because we know that the government will continue, the central banks will continue to stimulate, and interest rates will keep low for the next at least 2.5 years. So that's a positive. So the next positive we see in the market is the amount of stimulus by the government. So this is from the IMF data. So as we all know, during the global financial crisis, there was already a lot of stimulus, especially from China. But you can see right now for this year alone, the government is not stopping, especially the US. They're probably, I think they're coming up with almost 3 trillion of stimulus. So you can see that if you measure this against GDP, the amount of stimulus coming out from governments globally is double what they usually produce. So they are responding very aggressively to this whole pandemic. As you can see, last year they used to be, okay, deficit, again, sorry, some may not understand, but it basically means the amount of revenue a government collects versus the expenditure. So the governments are spending more than what they actually collect to help support the economy. So you can see that they used to be globally about 3% deficit to the GDP, but right now it's almost 3 times more. So there is a lot of stimulus, and of course this is good for the markets or for the economy, that during this weak period, pandemic period, that the governments globally are coming in to help out the real economy. So that's a positive. And if you go from the Singapore side, of course, our fiscal response is probably one of the most aggressive in the world. So this is the top 10 countries in terms of response to COVID-19. Again, this is all IMF numbers. You can actually get it from their fiscal monitor. So you can see globally, we are probably ranked second. We could actually even rank first because a New Zealand stimulus here could be over 2 years, but ours is 1 year alone, we're going to have a deficit to GDP. So there's a positive to it. Of course, some may argue otherwise. The positive thing is that we can afford it. So we are one of the few countries. If you're an emerging country, some of those younger countries, less developed countries, it's going to be hard for them to respond like how Singapore can respond, because firstly, they have to worry about the currency. If they print too much money, then the currency be affected. But we are lucky in the sense that Singapore has the resources to stimulate. And just of course, these are all the budgets you can just for your reference, but our budget 2019 was about 0.3. So right now our budget is going to I don't know how many times, it's about 15%, and we're drawing on our reserves. So what it means that we at least we are in a good financial standing to actually respond. Obviously, it is good for the economy that during this period of time we have the resources to respond, and we are probably one of the largest in the world. And this is basically just a reference of the amount of money that they're going to be spent. But not all of this 92 billion is actually outlay. Some are guarantees and so forth. Okay, I'll quickly move on. Okay, the other plus, again, my background is accounting. It's not to understand vaccines, but this is just the data that we have. So you can see that we got this from a New York Times article, because it's going to be hard for us to compare 140 companies. But what it shows is that there's more than 140 companies looking for a vaccine. Again, and 3 are already in phase 3. Obviously, this is important, as we all know the news of a vaccine can actually move a market. Of course, whether the vaccine actually will arrive at our doorstep for the whole masses, available for the whole world is debatable. But if news of a vaccine will can cause the market to rally, as we've seen news on some of these names that you see below. So if we get the approval, we could see the market move start to rally harder if there's one or two of these 140. So that comes to the approval stage in the US. So this is the US FDA approvals. And some of these companies, some are Russian, some are Chinese, some are US. So there is a global effort. And of course, it's a positive that we, like globally, so many companies are trying to find a vaccine for this pandemic. Okay, this is just the last part on the so in terms of valuations, our valuations are still very cheap. Those who attended, I think I mentioned this so many times. So obviously, this is not going to be a very can be a mute point, because we can be cheap for a long time. But just to remind everyone that the market is still very cheap. Okay, this is a dividend yield. So if you measure our market in terms of dividend yield minus the 10-year bonds, so in a way, this is like our dividend yield versus the FD. So would you put your money into our Singapore market, or would you put your money in the FD? So if you look at the difference, you can see that our dividend yield is still at record levels, as high as during the financial crisis. And in terms of dividend yield, we rank the highest. So so our banks look attractive, especially if you're a foreign investor looking for yield. We stand up even against the earlier mentioned the MSCI Asia X Japan. Again, for PE, we are at the average levels, but because we cut our earnings, I think not only for us, but I think the whole industry, the analyst consensus cut earnings for this year by 26%. So this one is like a COVID impacted kind of valuation. So if you exclude actually our earnings, our valuations will probably be at the low, probably low teens. Yeah. Okay, okay. The minus is the big problem, obviously, COVID. If you look at this is the 7 moving average globally and among the rest of the world. So initially we were upbeat. The large companies, because what we saw was countries like China, Germany were actually containing the outbreak. So the number of new cases a day were actually controlled. But I think this is the US factor. But the problem we have now is that the cases globally continue to rise, and it's still stubbornly high. And a lot of it is coming from emerging, maybe Brazil and so forth. So this is the problem that we still have for the market. So this is a minus, and until we see this stabilize, then the market could rally even harder. But this continues to increase. For Singapore, the good news for Singapore is that I know there's a lot of lines, but I think the line to focus will be on the red line, which is our Singapore's moving average. So before we had circuit breaker, before the government came down hard to try to stop this outbreak, you can see that the number of cases in Singapore was about 55 and 63. I'm talking about community and imported cases, not those in the dorm. So it was because it rose to these levels that we had the huge circuit breaker. So, and before then they relaxed it in 2nd June was because the cases was about 5, phase 2 about 7. So I mean the key point here is that so long as cases, I know I'm just pulling a number below 10 or it doesn't hit to these kind of levels, we should expect the phase 2 to even relax a bit more, to maybe the people in 5 groups to maybe 10 10 people in a group and so forth. So the most important is this number. So we are tracking this closely. So long as after phase 2 there isn't any surge, we don't expect the authorities to roll back to phase 1 and so forth. So we are in a good state. I mean, in a nutshell, for Singapore, the cases are actually contained. And also, we also see the cases are contained in some of the worst hit countries. So the positive is that you can contain it. I mean, you can see like in Italy, they used to have 5,000 per day. Now it's about 200. In China, they're about 20. They used to be 1,000. Then in South Korea, it used to be a few hundred. Now it's about 40. So you can contain. So that's the positive. Although there will be a short-term impact to the economy. Of course, the problem we have is so for the US, this is the most technically our most, in terms of jargon, is the most technically sophisticated. So the US, please wear mask. Okay, so the problem is that this is the problem that is going to be an issue for us because if this continues to rise, then you will see more lockdowns. Again, this is 40,000. You know, the new number is probably 50. So if this continues, this outbreak is uncontrolled in the US. So this is the big tail risk that we're going to have. So there will be a second wave of lockdowns again coming into the US. So this is the thing that this is the minus that we have for the market. Okay, this is the other minus. I mean, depending how you read this. Okay, this is a bit complicated, but okay, this basically means this is rather than give you polling numbers. So you can see that Joe Biden, as you know, both are competing for the US elections in November. So Joe Biden is taking the lead, and what it means is that if you bet $150, you only get $100. So obviously this guy is taking the lead. So I'm not going to comment too much because it's politics, but both of them are also, you know, they have this anti-China kind of in their campaign, but of course he's less than Trump. So and what we are worried is that as we approach the elections, both will be speaking even harder against China, and you know, the whole trade deal might break down and so forth. So that is another minus. It's quite unpredictable, obviously, but I guess depending your viewpoints, he is taking the lead. This is from all the, you can go to this website and just go and see the odds rather than see the polling numbers. This is the odds that he will be the next president. Okay, I will move on to Wei Ren. He will just quickly run through how he sees the market technically. Then later on, we'll move on to sectors and so forth. Wei Ren, you want to continue?
Okay, thank you very much, Paul. Very good morning to all of you on a beautiful Saturday morning. So on my part, I'm going to share on the STI index and what's the likelihood of a market direction in the next 2 quarters to end of 2020 and perhaps even the first quarter of 2021. So next slide, please. So this slide, it shows that the Straits Times Index weekly chart has seen some uptick after a rebound, but prices still remain below the key psychological resistance level at 3,000. Ever since the sell down started in March, the STI index fell below 2,500 for the first time since 2011 after the great after recovery from the GFC in 2008-2009 period. And although recently it rebounded, like what I mentioned in the previous outlook in the Q2 2020 and our March report, where prices rebounded near support at 2,305, which is near the 161.8% expansion level of subwave 3. So I mean, for the wave, you can count is based on the chart. So 161.8, I think you can see very clearly. So back to it. So last month, price had a very strong sell down again, below 50% of wave 3. But as of yesterday, weekly bullish engulfing candle was seen at the lower support level of the channel. As such, we see a very high possibility of STI testing the resistance zone between 2009 and 2,954% once the 50% level is broken. And so in order for the market to resume its bullish outlook, the Straits Times Index need to break above 3,000 psychological level minimally. Otherwise, the recent upside will be seen as corrective action. And just to add on some of my personal, I think the recovery will be very slow. Breaking 3,000 psychological level, I think in the near term, we won't be seeing that. We will see price actually testing 2008, 2009, and after that, there will be a sell down. Okay, so how strong is the sell down? We have to see on future data. So next slide, please. So for the daily chart, it presents a very clearer picture picture, with price staying supported above 2,636 to 2,598. As such, we believe that the index will test the resistance zone at 2009 again, which confluence with our weekly chart analysis mentioned earlier. Okay, so next one is STI also has a breakout of the falling wedge on Thursday, together with the support, and the rebound was the strongest in the past 2 weeks. However, near-term resistance remained at 2,692, and it remained a strong obstacle to be tested. So what does this mean is, if you look at the immediate resistance zone, which I highlighted in the chart, that is the zone that need to be broken within the next 2 weeks. So it's like a near term. So without breaking it, we'll see price revert back to the support zone, the support term resistance zone, or even below at 2004. Okay, so next slide, please. So in this climate, what's the best stocks that, what's the best blue chip to actually look at it? What's the best blue chip to look at it other than the STI component index or the small and mid cap? So I think for the best risk reward stocks that from a technical outlook, I think you can look at DBS. Why do I say so? Risk reward is rewarding, and from the chart, I think it shows that the price rebounded at $17.31, which aligned to our past report in March period and the Q2 2020 outlook. The only difference is that I thought that I mentioned that the rebound won't stay above $21 or $20. I can't remember, so I need to go back. So, but DBS performed better than expected, and it broke the $20 resistance level, and then it became a support. Okay, and then DBS actually broke above the my targeted sell zone, and then it ended at near $24. Okay, so however, we are cautioned to take this rebound as a recovery, as the Elliott wave and technical indicate that there might be another extension of wave C. Although there's a wave C is like kind of complete, but we are still very cautious about it, given the fundamentals that which Paul already mentioned about how the market is. Okay, so as long as the stock stays above $20, the stock will likely test the resistance zone at $25. However, should DBS remain below $22.50 to $23.24, DBS will likely form a complex corrective subwave pattern. We will see price ranging from $22.50 to $20 range. Okay, so with that, I end off my presentation. Any Q&A, just put in the chat, and I pass back my time to my colleagues to share the sector's outlook. Thank you very much.
Okay, thanks, Byron. So we'll just move on now to the more, I guess, the more interesting parts. We'll just give everyone just a quick update on the various sectors that we cover. Okay, or our views or our guess, I guess. Okay, anyway, I covered the telco sector. This is to give you our views on the telco sector. So anyway, the main point for us on telco sector right now is that without roaming, it will bite earnings. So you can see this chart is basically the postpaid ARPU. Basically, the price for StarHub, it used to be like 70. You can see it used to be about $70+ and for Singtel also around there. So you can see that in late 16, you see this sudden plunge, and obviously that it hurt StarHub share price a lot. What happened was that all the telcos started to drop prices, and it is no coincidence that this is also the time when the IMDA announced the fourth operator, which was the TPG. So I mean, all the operators knew that the TPG was coming, so they immediately dropped prices. So this hurt. So since then, it's been dwindling down, but we actually did upgrade our StarHub view, but mainly because we saw that prices started to stabilize around these levels. But what happened was in the first quarter, because of the outbreak and with a number of tourists or inbound or outbound virtually stopped. Now it went to zero almost. That you saw that the postpaid prices or ARPU dropped to a new levels. So this is the issue we have right now with the whole telco sector, and it will probably stay low until we get inbound and outbound travel. So anyway, just to go back to the bullet points, the roaming revenue, just to remind everyone, is a very profitable part of the telco's business, because when we go overseas and roam, it hardly costs the telco anything. Likewise, for any tourists that come into Singapore, again, it doesn't cost Singtel or even StarHub any money because the infrastructure is already there. So the margins are pretty high, although they never disclose. So we estimate there's a certain part of they also do not disclose the amount, but we think maybe around 10% of revenue. So this part will going to bite on the telcos for at least the next 3-4 quarters. No, because basically, if you look at the latest tourism number, the latest arrivals into Singapore, this is not a typo. There were only 748 people that entered Singapore in April versus a year ago, 1.6 million. So you can get a sense of how that basically roaming revenue disappeared for them. So we think this will hurt the telcos for the next few quarters. So for Optus, I will just run quickly due to time constraint. For Optus, it's also hurting Singtel. I think Optus, as you know, is Singtel owns Optus. Is the second largest mobile operator in Australia. So that also is hurting Singtel because they lost this NBN. Is our equivalent to our NetLink NBN. So as a result of that, they do not have their own fiber. Then they have to become a wholesaler. So as a result, the margins got hit. And in the most recent results, excluding NBN, I think Optus earnings was down almost 60%. The other part is, of course, associates is the bright spot. India is the bright spot for Singtel. I think after 2-3 years of brutal price war, really brutal until I think there used to be the exact numbers probably 6 to 7 operators probably right now dwindled down to 3. It's performing now because now finally prices are started to recover. So there's a healing process underway, and that is positive. But the other markets, as you know, Singtel owns the largest mobile operator in Indonesia, and also in Philippines, the second largest. There's only 2, so or upcoming 3. So what is happening is that in emerging markets like Indonesia and Philippines, it's a different situation. It's not like us where we pay every month we pay the fixed amount, but over there they pay what they use. So when the economy is weak, you worry that they will spend less. Because it's like pay as you go, so because it's prepaid, so the weak economy will hurt the associates more in the emerging markets. Not like us, because ours we are fixed. Whether we use or don't use, we still have to pay the same amount because it's postpaid. So that's the result why we think there's a lot of pressure on the telcos, and that's why we are neutral. And also both telcos are not guiding anything. So they're not giving guidance on the dividends that they're going to pay. They're not guiding on the earnings. So I guess it's just a reflection. The outlook is really hazy, lack of better word, kind of a really poor outlook for the telcos. Okay, I don't cover aviation, but I know it's a hot topic right now. So we just try to we just explain what the data tells us. I only cover sets, so I'll just let you know what the data is telling us. So as you can see from our title, a lot of patience is needed. The reason why we say so, okay, so these are the numbers 9/11, because this pandemic has never happened before, so there's nothing for us to fall back on. But what we can look at is how did the US passenger airline traffic, how did they perform after the 9/11 event? So as you can see, after the 9/11 attack, it took 2 years for traffic to return back to normal. For us, in Singapore, when SARS happened, it took about 12 months. Again, we do not know how this pandemic, and of course, in 9/11, there was also the impact of a recession and the economic impact that also kind of pressed down on traffic. But what we can say is that if 9/11 take 2 years and the current situation is even more severe, I mean, it's reasonable to assume you will take at least another 2 or even more years for airline traffic in at least for Singapore to return back to normal, especially for us where we don't have any domestic travel and we have to rely a lot on international. So that's why we are saying if 9/11 take 22 months, it's safe to, I mean, you can assume that ours could take even longer. And just a latest update on the passengers that's being carried by SIA. This is important also for SATS because SATS relies a lot on SIA as a customer. So as you can see here, again, this is not a typo, and also expected. Okay, SIA carried about 8,000 passengers in May. In the month of May, a year ago was almost 1.8 million. So I mean, you can see how drastic, and that's why they need to kind of obviously mothball a lot of planes. Although there are green lanes now with China, and they are allowing more traffic, but it is a really you are basically given a swab test in China, giving a swab test in Singapore when you arrive, and you need sponsorship and so on. So it's a very tedious process to come in, even under the green lanes. There's a YouTube video here, I mean, by China News Asia. So if you want to know more how this green lane, how cumbersome it is, it's just for a reference for everyone. But we just wanted to emphasize that it will take some time before aviation resumes to the norm or even recovers to, you can see from this chart. Okay, I'll move on to the next. For land transportation, which I also cover, I think we can read this chart for yourselves. I think the SBS, the real traffic, just collapsed. So this is basically traffic in the Northeast Line, Downtown Line, and LRT for SBS. And this is the taxi. We do get a lot of questions on comfort. Although we show you the earlier chart, the mobility chart, where transportation is improving, but the problem we have with comfort is the competition. As you can see, so this is the number of rental cars. You can assume this is the Grab line. Of course, not all is used for Grab, but you can assume this is the number of Grab cars out there. As you can see, it continues to rise. Up until recently, it dropped, and taxis also has been falling. So what we are more concerned is the beach line, the ratio. So this is the ratio of, instead of private cars, you can say the ratio of Grab cars to taxis. So in 2015, it was 1:1. So you see one taxi, you see one Grab car. So now this is risen to 4.6. So the competition continues to rise for taxis. So that's why we are a bit hesitant to be positive on comfort, even though there will be a recovery because the circuit breaker is over and we are phase 2. But the problem we worry is that the competition will still remain intense and getting worse. Of course, market share for comfort will be better. I think comfort will grab more market share in terms of the taxi population. And also, taxi supply dropped by almost 3,000 from a year ago. Okay, in terms of marine sector, we don't cover, but I know it's a hot topic. Okay, but just for everyone's benefit, again, this is just what the data tells us. So the red line here is the order books of Keppel and Sembcorp Marine order book combined. So the problem we have is that even before the recent crash in oil price in this 2020, we see that the order books already dropped. So with the oil price dropping, so the order books already fell from 7.4 combined to 6.8. Even before oil price dropped, and you can assume that with the oil price dropping these levels, it'll be worse. And also now this is the capex. The blue line is the capex for all the oil majors, not all the ones that we track. So there's going to be a 20% cut in capex. So you can assume that it will be a really rough year for them in 2020 and even 2021. Only 2021 you can see some pickup in terms of the order books, but like I mentioned, even oil price didn't drop. The oil majors capex was actually rose in 2019. Your order books already down, so the outlook will be tough for both yards. This is our quick chart on this. Our long-term view on crude. How we monitor is that the blue line is inventory. So you can see we used to get good. Of course, the Brent crude prices used to be 100. The red line when inventory was about maybe 300 million barrels and so forth. But now that it's hit 500, it will take a long time for it to recover. Again, not going to go too much on this because this is way too lengthy then. Okay, the next one, just two more charts for me on sector is the technology. Again, I also cover technology. Okay, anyway, you can use this as the US spending on e-commerce. So you can see that there's a big surge. Retail sales in the US is down, but you can see that all the spending is now moved to e-commerce. You can see from the big chart here, this is the fastest growing. We've never seen such a huge growth since the data was collected. And the trends, I think we all know, everyone is spending more online. That's why it became a Q10 VIP member for some. And also, so what's happened is that the consumer budgets have also moved. So most of us cannot spend on travel and leisure. So most of the budgets now is shifting to goods. So that's why it's positive for e-commerce. And the other trend that we see is that everyone is working from home, playing games at home, and spending money from home. So as a result, there's more and more capex being spent on cloud. So what we're trying to say is that the demand for technology is resilient. Of course, the one that's hurting, we don't have a chart here, is the 5G. So a lot of the telcos are cut back on their 5G capex, and also there's a lot of delay. I mean, even if now I always say if people lose their job or income is cut, nobody's going to buy a new phone. So that has been the one that has been hit, which is the 5G, the mobile phone sales and equipment that has been a hit. But what I'm trying to say, the message here is basically is demand has been resilient because of some of these trends that is happening in the technology. Okay, I'll move on. This is the last one for me. Again, we don't cover, but this is the very hot sector and has a lot of momentum in it. So this is the rubber gloves. So I guess the best one to summarize how good, I think if there's an industry you want to work for, this is going to be the industry. You work in the sales department for rubber gloves is going to be the best, because I think this explains it. Before COVID, if you order a glove, you have to wait 30 days to 40. This is from Top Glove, the results. You order a glove from Top Glove, used to be 30 to 40 days. Then in April, if you order a glove now, you have to be 300 days. So you wait, so you order today, you wait next year. But the latest one they gave in June is going to be almost 1.5 years, or almost, I must say, more than a year. Okay. So you order a glove today in June, you have to wait 420 days to get your delivery. So basically, there's no supply. So that's why we order. That's why our title is order today, then you get it next year. So that's why. And what's happening for the glove sector is that the prices have shot up, and the cost doesn't move up. And with the oil prices down, actually their costs came down. So it's going to be a really great year for the glove sector, and that's why like Top Glove market cap is actually higher than some of the banks in Malaysia. And that's the data. This is a bit lagging, but you can see that the exports have. This is only up to April. So the exports, glove exports in Malaysia is actually surging in Malaysia. Okay, anyway, we don't cover, so, but I just wanted, because this is probably the only one of the few sectors that has a lot of there's a huge momentum in it. Okay, I will move on next to Natalie, she'll cover on the property sector. Natalie, over to you.
Hi, okay, good morning. So jumping right into the property sector. So you can see the graph on the left shows the property price index and the number of unsold units. So the more frequently mentioned number is the 49,000 units in a pipeline, which will be delivered from 2020 through 2023. However, if you look at the number of unsold units, which is represented by the blue line in the graph, only 29,000 private housing units are unsold. And this number of unsold units has actually fallen by 20% year on year from the high in the first quarter of 2019. The price index, represented by the red line, has experienced 2 quarters of decline, dipping slightly by 1% and 1.1% in 1Q and 2Q respectively. So the graph on the right shows the sales momentum for new units. The showrooms were closed during the circuit breaker period in April and May, and developers have resorted to giving virtual tours instead. And understandably, the sales volumes were lower, but developers still managed to move 279 and 486 units in April and May respectively. So while sales recovered by about 74% in May, sales in May were down 43% year on year, as represented by the position of the red line, which is below the black line. So on to the next slide. Okay, so we are not expecting a sharp fall in property values, but rather a mild correction. We expect private home prices to fall by about 5% in 2020. The volumes to come in at the 5-year average, which is about 8,000 units. We see 5 factors supporting property prices. So first of all, the land sites for 6,670 residential units were released in the second half 2020 government land sales. And in the graph, you will see that the number of new units released has been kept at around 6,000 units over the last 4 quarters. And this is the lowest compared to the number of units released over the last 10 years. Sorry, I apologize for the plane flying overhead. Okay, so as I was saying, the 6,000 units over the last 4 quarters is the lowest compared to the number of units released over the last 10 years, which ranges between 8,000 to 14,000 units. The government has reduced the supply of private residential units on the confirmed list, which is indicated by the blue part of the graph. The number of units on the confirmed list for the second half of 2020 was 1,370, down from 1,700 in one month.
There's an issue with your audio, sorry. Yeah, can you just repeat that again?
Oh no, okay. Okay, sorry. I'll jump back to the 5 factors that we see that are supporting the property prices. Is it better?
Yeah, please go ahead. Yeah.
Okay. So first of all, as I was mentioning, the land sites for 6,670 residential units were released in the second half of 2020's government land sales. In the graph, you will see the number of new units released has been kept at about 6,000 units over the last 4 quarters. And this is the lowest compared to the number of units released over the last 10 years, which ranges between 8,000 and 14,000. The government has reduced the supply of private residential units on the confirmed list, which is indicated by the blue area, and the number of units on the confirmed list in the second half of this year was 1,370 units, down from 1,700 over units in the first half. So this is the lowest number of units on the confirmed list since the GFC, where only 1,100 over units were released in the second half of 2008, and no units were released for the whole of 2009 on the confirmed list. Okay. So secondly, the lower interest rates and lower selling prices may help to spur sales. So the reference borrowing rate SIBOR is down by almost 1%, and prices are more attractive as developers have lowered their price expectations in order to maintain selling traction. Thirdly, stabilizing policies passed in the COVID-19 bill will help to keep prices stable, and the allowance of loan payment deferments prevents homeowners from defaulting and having to liquidate their assets. The extension of the ABSD, which is your additional buyer stamp duty charges deadline, also prevents the upgraders from letting their options to purchase lapse in order to avoid ABSD charges if they are unable to sell their existing property. So this extension of ABSD also benefits the developers. Fourthly, the land prices over the last few years the higher land prices over the last few years does not leave developers with much room to cut prices, as they will strive to protect margins. So we do not expect deep discounts to be given and the property prices to be relatively stable. Lastly, we see that the households seem to have a stronger balance sheet, as indicated by the lower loan-to-value ratios of 49% last quarter, in the first quarter of 2020, compared to about 53% 2 years ago. Next slide, please. Okay, so in the graph on the left, the red line shows the property price index. As you can see, there were two periods where we saw very strong price appreciation, where the price index grew faster than household incomes. The price index has corrected slightly and is now below the blue line. So as mentioned previously, the price index dipped by about 2% in the first half, and we expect another 3% fall in the second half of the year. In other words, the present is a comparatively more attractive environment for home seekers and upgraders. So the graph on the right shows the loan-to-value outstanding on existing home loans, and we can see that over the last 2 years, the LTV ratio has been declining, suggesting that home owners are better capitalized and have taken up less loan financing. So moving on to the next slide, about the REIT sector. So before jumping into the subsectors, let me just briefly talk about how COVID-19 has impacted the REITs. The impact to the landlords varies by the underlying tenant's reliance on the premise to generate income. So therefore, the degree of business disruption of the underlying tenant, and therefore the amount of rental rebate that has to be rendered, as well as future demand for space arising from behavioral shifts and change in occupier strategy. So among the subsectors, the retail and hospitality were the most affected. Retail due to the non-trading of non-essential services and the rental waivers offered to tenants, and hospitality due to border closures. The industrial and commercial sector was seemingly more resilient, as underlying tenants did not face much business disruptions, and they were able to telecommute, and about 60 to 70% of industrial tenants were able to operate within their premise. So additionally, just want to add that actually supply for all the subsectors is actually relatively muted in the next 5 years, and this will actually help to support rents. So now jumping into the office subsector. For the office subsector, as you can see from the table, the graph, the occupancy and rental index fell slightly in the first quarter of 2020, And occupancy fell marginally by about 0.5 percentage points, while the rental index fell by 1.3 points quarter on quarter. So office prices also showed some weakness, falling 4% quarter on quarter. So as mentioned, office tenants have a low reliance on premise to generate income, and they were able to telecommute. Hence, office REITs did not need to extend much by way of rental rebates, except to tenants providing ancillary services such as the F&B and fitness operators. Moving forward, we do expect vacancy rates to rise. There are counteracting leasing strategies at play here. So on one hand, some tenants may actually choose to right size or employ more flexible or remote working strategies, and the successful implementation of telecommuting poses risk to office demand. We might also see companies choosing to adopt. However, we might also see companies choosing to adopt lower desk densities, split offices, or core plus flex models, and hence that might increase the demand for space and even demand for flex space. So moving on to the next slide, the retail sector. So obviously, entering phase 2 will lift malls. The occupancy dipped by about 0.5 percentage points, and the rental index fell by about 2.3 percentage points, similar to what we saw in the office subsector. There's a high reliance of premise to generate revenue. So and therefore, this is the subsector that actually offered the highest amount of rental waivers to their tenants. About 2 to 3 months of rental rebates were offered out of pocket by the REITs. So we do expect some increase in vacancy rates, as well as lower rental reversions due to the softer leasing outlook. And there's some silver linings. I'll elaborate a little bit more about this later. So throughout this COVID-19 period, the landlords have actually tried to help tenants by launching their own food ordering platforms and etc. So that that might help tenants actually be able to trade more, especially the F&B tenants. And this will, in the long term, actually increase customer and tenant stickiness. Elaborate more later. So moving on to the next slide. This is the retail sales index excluding motor vehicles. So this is the latest numbers for May 2020. So as you can see, the RSI excluding MV is it fell by about 46%. Year on year in the month of May. So this is even worse than the previous month. So we expect this will be the worst. Okay, so for the RSI, it was weighed down by discretionary trade, so your fashion, jewelry, departmental stores, and the only positives were the fast-moving consumer goods, so supermarkets as well as the convenience stores. Even the F&B index was negative by about 51%. Okay, move on to the next slide. For the hospitality sector, so Paul previously mentioned about 748 international tourist arrivals last month in April. So this month, slightly better, 880 international tourist arrivals. So still virtually about 100%. The international visitors actually fell about, it's actually still 100%. So hotel RevPAS, as you can see in the table, in the graph, it fell by about 76%. And in April, it fell by 80%, so it's slightly better. And the occupancies, industry occupancies has actually risen slightly, 57% compared to last month, which was, compared to the month of April, which was 41%. So what we did notice is that accommodations with lower price points, your economy as well as your mid-scale accommodations, they were less affected in terms of impact to RevPAR compared to the higher price point accommodations like your luxury. And of course, the fast lane arrangements that are being negotiated for China, for Malaysia, that will actually help. To allow essential trade will actually benefit the accommodation providers very marginally. So of course, the headwind for this sector will be the lingering fears and caution that will reside even after international travel bans are lifted. Okay, moving on to the next slide. So for our last subsector is the industrial subsector. It's relatively resilient for now. So in the graph on the left, we see that the rental index and occupancy has held steady. And there was some COVID-related demand for storage of consumable necessities. the relatively high percentage of operational tenants, especially in asset classes where telecommuting was not possible, such as the light industrial and logistic assets. It does give some comfort regarding the degree of business disruptions and the number of tenants that may require rental waivers or deferments. Okay, so the second graph, the graph on the right, actually shows you the breakdown of supply that is coming onto the market for the industrial subsector. The supply coming on is relatively muted. The most supply is coming on in the light industrial asset classes, which is the light blue bars. So, but then the supply for the business park and high spec is still relatively muted in the following years. So that should actually help provide some rental growth. Yeah. Okay, on to the next slide. So we actually feel that presently, okay, sorry. So we actually feel that there will be a re-rating for the S-REITs, and the current environment is actually very favorable and conducive for the REITs for 5 reasons. So first of all, REITs will benefit from the higher leverage limits. So as you can see in the graph on the right, amongst the REIT markets, Singapore and Hong Kong have the lowest gearing limit of 45%, Malaysia 50%, Thailand 60%, and other developed REIT markets such as Australia, Japan, United States, and France do not impose leverage limits. So despite the conservative leverage limits S-REITs are subjected to in Singapore, gearing ratios for most S-REITs range between about 28% to 38%. Yeah, and S-REITs maintain a minimum of 5% buffer from the statutory leverage limits. So this higher leverage limit is actually beneficial, or we view it positively. I mean, okay, so to prevent accidental breaches of the leverage limits due to market forces beyond the REIT manager's control, such as deterioration of asset values, and to provide REITs the flexibility to draw down on debt facilities to meet cash flow needs, MAS raised the leverage limits to 50%. So we actually do, as I mentioned, we do view this favorably as it actually allows the REITs to more flexibility to optimize their capital structure, as well as when competing with other private funds and other REITs from different geographies for assets. So it allows them to gear up more quickly to compete more on a better, more even playing ground. Sorry. So for the second reason, we see that COVID-19 is only an accelerator of the technology-enabled structural shifts, and it has actually provided landlord opportunities to make their portfolios more future-ready. So right-sizing, be it through tenants becoming more efficient with their space requirements or averaging down of costs through the hub and spoke strategy, has been a pre-existing risk for the commercial sector. Similarly, the trend of e-commerce has been a growing one over the years. So for the office sector, as the structural shifts begin to gradually unfold in this uncertain economy, the outlook for flex space operators is optimistic as an intermediate stage in the change of occupier strategy, as well as a scalable solution for new businesses entering the market. And pre-COVID, we actually see active tenant management and landlords have been exploring various methods to pad demand, as well as increase tenant stickiness. The new demand from flex space operators has helped to soak up some of the office supply in the recent years. And we have seen some developers and REITs take stakes in the co-working operators to get a better understanding of the operations and sustainability of this trend. So for the retail sector, pre-COVID, retailers have already been embarking on reward programs to drive tenant and customer stickiness, and also to encourage the embrace e-commerce trends through the promotion of omni-channel model. So during this circuit breaker period, we saw that CapitaLand Mall Trust and Fraser Center Point Trust, they launched their respective online food ordering platforms, which these online food orders can actually be fulfilled by 3 methods of delivery, which is either delivery, takeaway, or dining options. Dining options obviously is passed once in phase 2 onwards. So what has happened here is that the pandemic has actually accelerated the adoption of e-commerce and digitalization to complement the brick and mortar model. Yeah. So in this extended period of non-trading, April and May, especially for non-essential trades, provided the opportunity for retail landlords to display their adaptability and build a stronger ecosystem to drive tenant and customer stickiness. These initiatives will not only help tenants during this period of depressed sales, but position traditional retail landlords for the future. On to my third point, which is REITs have been tried and tested, and we believe that as REITs remain an attractive yield play, testament to the leasing strategies and portfolio attributes that have been embedded in their portfolios. So it is true that DPU for 2020 will take a hit. However, this was due to the rental rebates that were offered out of pocket to show solidarity with their tenants and etc. But however, over the years, we see that REITs have actually implemented leasing strategies and portfolio attributes that will help to maintain stable distributions. These include long WALEs, well-distributed leases and debt expiries, balance of stable and growth leases, as well as prudent interest rate and FX management strategies. So DPU for most REITs are expected to be lower in FY20. However, barring these extreme events, and in spite of the structural shifts that will unravel during the following years, we believe that REITs have incorporated sufficient stabilizing attributes and will continue to provide stable distributions. Not to mention the postponement of government land sales and landlords exploring redevelopments and change in use. We believe that the supply will adjust to help the real estate sector achieve a healthy equilibrium. So fourthly, we see that current prices present a better entry price. Maybe I'll move on to the next slide. Okay, so this is the better entry price that I was talking about. So as you can see, So dividend yield spread is currently about 4.5%. This is around the average of the 2019's average, and the dividend yield spread is about 3.6%. It has actually expanded by about 100 basis points due to the lower interest rate environment. Currently, where we are at the dividend yield spread is at the positive 0.2 standard deviation level, as seen by the dark blue line in the graph, and it is hovering near the red line, which is the mean. And so this compares favorably to 2019, where you can see that the dark blue line was persistently below the lower green line. So it was trading around the -1 to -2 standard deviation levels. Sorry. So for the last point, the fifth point, which is on the next slide, we see that the recovery in prices as well as the low interest rates actually presents a conducive environment for acquisitions. So first of all, interest expense actually accounts for about 30% of expenses for the REITs, and with the recovery in share prices, acquisitions which are usually financed through a mix of debt and equity will start to look accretive. Well-capitalized REITs will seize the opportunity to pick up distressed assets and at attractive valuations. So even last week itself, we saw the acquisition momentum sort of pick up. Fraser Centrepoint Trust acquired the remaining 12% stake in PGIM, this private retail fund, which Fraser's, along with their sponsor, has been taking a greater stake in. Additionally, just a few days ago, Ascendus REIT actually announced the acquisition of a Sydney asset. So coming in from 2019, where it was a year of a lot of acquisitions for the REITs, there were a lot of other acquisitions that were in the pipeline being evaluated, but those plans were put on hold due to the current situation and of course the collapse in share prices. Now with the recovery, acquisitions are starting to look more accretive. And lastly, on the next slide, you can see that historically REITs have exhibited. On the next slide, sorry. Okay, so historically REITs have exhibited an inverse relationship with interest rates, with periods of declining interest rates leading to stronger price appreciation, as you can see in the graph on the left. The periods of, you can see by the dual arrows, so periods of lower interest rate, you see that the share price, which is the light blue line, actually spike. Yeah. And also in periods of lower interest rate, you see on the graph on the right, in the light light blue shaded areas, those are the periods of lower interest rates. We see that REITs will actually outperform the STI index. Yeah, so okay, so that's all from me. I think next, I'll pass on to Wee Kwang for banking sector.
Natalie. Okay, so unlike the REIT sector, the banking sector will be impacted negatively as a result of the lower interest rate environment. So from the graph on the left-hand side of the screen, we can see that both 3-month SIBOR and SOR has collapsed to levels last seen between 2013 to 2014. This is a reversal from the initial resilience in the interest rates observed in April due to the funding conditions then. So the table below the graph actually shows you the average SIBOR and SOR between 2013 and 2014, which was around 0.39% and 0.25% respectively. So as it stands, current SIBOR and SOR is at 0.56% and 0.2%, and will probably stabilize at current levels. Nevertheless, the average interest rate in the second quarter is about 20 basis points higher at 0.72% and 0.42% for SIBOR and SOR respectively. This means that the impact felt by the banks when it comes to NIM for this quarter may be maybe not as much as what will be in the coming quarters. So on the table to the bottom right of the screen, we compare the NIM levels from the lows experienced by the banks in 2013, as well as the current NIM level reported by the banks in the first quarter itself. The third row showing the expected NIM level for the second quarter is just an average of the NIM across the 3 banks during 2013, which will impact the net interest margins of the banks between 3 to 11% across the different banks. However, this is assuming that the worst case scenario, assuming that there was an immediate crash from previous quarter, which is in first quarter, to the low of 2013 lows immediately. But as previously mentioned, with the second quarter average interest at about 20 to 30 basis points higher than the 2013 levels, the banks will not see the full brunt of the impact in this second quarter results. As a result, we believe that NIM will definitely trend downwards before stabilizing over the next 2 quarters from lower asset yield and flight to deposits in the current economic conditions. So we can also see that the banks are actively cutting rates on their high interest savings account, with DBS and UOB being the latest to announce interest rate cuts over the past week on their DBS multiplier as well as the UOB One account. So next, we'd like to move on to some loans data. Okay, so for the loans data, I'd like to draw your attention to the table on the left-hand side, which is below the graph, showing the year-on-year loans growth. So loans growth has been slowing and even fell to 0.51% in the most recent month of May, which is quite a steep drop compared to the previous 4 months, as you can see, about which was about more than 1%. So breaking down the loans into business and consumer loans, we can look at the table on the right-hand side. So business loans grew by about 3%, while consumer loans fell by about 3.5% year-on-year. Even though business loans grew, but the pace was the slowest in 13 months, as each of the past 5 months actually recorded year-on-year growth of more than 5% each. So what we observe is that a lot of the businesses are actually deferring some investments, especially during the circuit breaker period, as the firms are mostly undertaking cost-cutting measures to stay afloat instead of trying to expand. In the short term, there should be some headwinds as companies try to figure out a new normal as businesses start to resume in phase 2 of the economic reopening. For consumer loans itself, it has been shrinking already, but May saw consumer loans shrink even further by 3.48% year-on-year, with housing, car, and credit card loans, all shrinking across the board during the circuit breaker period as well. This is understandable, as it was hard to look for a new house or car during the circuit breaker when you're basically staying at home. Of course, when we move into phase 2 of the economic reopening, the malls reopening will boost some consumer spending, but big ticket item spending may still be suppressed, especially when you consider spending on travel for most people is probably like $0 right now. So all in all, the loans picture is not rosy as well, making the whole outlook for banking sector when it comes to interest income quite bleak. Next. Okay, as a result, most investors are actually falling back on the fee income to see a glimpse of any growth at all in the coming quarters. So in the table, it's just a results highlight of fee income for the first quarter of the year for the 3 banks. across the board, we see that fee income actually grew between 8% to 14% for the three banks in the first line. And we've broken them down into the various portions that actually contributes to fee income and filled it in with whatever information was provided by the banks as the banks move to semi-annual reporting. So these are the percentage growth that are just provided as an update by the banks itself in first quarter. The areas of growth will likely see, the areas of growth will likely come from brokerage fee and wealth management fee as we move into second quarter results. So for brokerage fee, I think we can agree that the one thing this COVID-19 has brought about was a flow of funds by retail investors in the stock market when everything started crashing down. So from SGX's data, we know that trading activity has heightened from a year ago, and even though it has started to taper off from the peaks in March, it is still about 30 to 40% higher from a year ago. For wealth management side, it has been a trend for a while now with quite stellar growth across the past 1 year. But during the circuit breaker, probably put some headwinds for them when like RMs from the different banks can't meet prospect clients. But now that banks are reopening all the branches and allowing face-to-face interactions with potential clients, this area should benefit in the coming months. So all said and done, there are headwinds in the banking sector, but we feel that it has been mostly priced in by the market. Next. So that's all we have for the sector outlook. We will now move on to our stock picks for the quarter. On screen is our Phillip Absolute 10 model portfolio, which includes the top 10 counters under our coverage that we have the most potential in the current climate. So just a forward that we have shifted the focus on yield play in the current economic conditions due to the attractiveness as mentioned by Paul previously. Okay, so you can take a look at the performance of the Absolute 10 portfolio versus the STI in the table on the right. So unfortunately, our portfolio looks to be down about 7.4% year to date. But I guess we can all take comfort in the fact that compared to the STI, which was our benchmark, which was down almost 20% year to date. So in a way, we are still beating the market. So for the third quarter, we actually removed 3 counters, Sheng Siong, StarHub, and UOB, and replaced them with Asian Pay TV, DBS, and Yoma respectively. So we will now go through some investment highlights for each of these 10 counters within the Absolute 10 portfolio. Next. Okay, so firstly will be DBS, our only banking sector call right now in the portfolio to replace UOB previously. On the left-hand side, you can see the first quarter results highlight of DBS. Generally, the first quarter results showed a strong business momentum that can help to buffer not all, but some of the negative impacts as a result from the COVID-19 pandemic. So across the 3 income segment of net interest income, fee income, and other non-interest income, they all recorded pretty good growth in the first quarter to see record income and pre-provision operating profit for the first quarter. Next, we can recap previously that as we head into second half of 2020, we think that the wealth management and brokerage related fees will benefit in fee income across the 3 banks. But DBS with a stronger investment banking franchise may actually get a bigger boost as the go-to capital raising bank among the 3 local banks. Furthermore, having a quarterly dividend of 33 cents represents an annual yield of more than 6% right now, which is also the highest among the 3 banks, which are paying dividends on a semi-annual basis instead. So that's all for me. Next. So Natalie will just carry on with Escort REIT.
Yeah. Okay, thanks, Wee Kwang. So for Escort REIT, we like Escort due to the stability of their revenue streams, as well as the outperformance of the service select accommodation type. So first of all, drawing our attention to the pie chart, you can see that the first pie chart, you can see that this is actually the lease distribution. So for Escort, the stable revenues come from the master leases, the red portion, as well as the management contracts with minimum guaranteed income. So that's the floor. It's sort of a floor income here, represented by the green area. And then the more growth or variable kind of revenues come from the management contract, which is a dark blue portion of the pie. Escort actually targets a 50-50 split between the growth and stable revenues. So this actually helps them to sort of maintain a more stable DPU. Additionally, you can see that in the pie chart on the right, that Escort has very relatively well diversified kind of geographical diversification. They have 88 properties across 15 countries. So that means the asset concentration risk per asset is actually very low. Not to mention that for the management contracts, there's actually also a 41 to 59% split between corporate and leisure customers. So the corporate side is the one that provides a more longer stays, and that also helps to add more visibility for their revenues. So this is where the stability comes from, geographical diversification as well as lease structure diversification. And then you can see that in the in the graph below, this is actually Ascot's sponsor, the Ascot Limited, which is a wholly owned entity of CapitaLand. So their sponsor is a accommodation sort of operator, and they are basically very rapidly trying to increase the number of keys under management. So how this benefits Ascot is they're currently about 10,000 over units, rooms that are actually under Ascot brands. So the Ascot brands are, of course, Ascot, Somerset, and Citadines, as well as the new one, which is Liv. So with more of these Ascot branded kind of accommodations popping up, the branding will be more prominent over the years as it grows. And so Ascot also has a target of 160,000 keys over the next 4 years. So this global footprint, as well as increased brand recognition and loyalty programs, will actually help to benefit Ascot as well. Last point to touch on is the sort of outperformance of select services. So select services, they are usually larger format kind of rooms, and with a lower price point. So with this more, as consumers are more, price sensitive, especially given this current economic environment, the lower price point kind of accommodations will benefit from this. So moving on to the next counter, which is Fraser Centrepoint Trust. Fraser Centrepoint Trust, we like them because of the resilient necessity spending and outperformance of the suburban retail malls. Second of all, you can see that we see organic growth potential for FCT. First of all, in the graph on the left, you can see that there is actually in the three largest malls, which are Causeway Point, North Point, and Waterway Point. These three malls will benefit from the increase in the number of HDB units surrounding in a surrounding catchment. And we also see inorganic growth potential for FCT. They have a pipeline of 3 assets from the sponsor, and also 6 assets from the PGIM private fund platform. So as mentioned, just last week, they acquired the remaining 12% stake for PGIM. And together the sponsor, they own 100% stake in PGIM. So PGIM currently owns, of the 6 assets, 5 of them are Singapore assets, suburban, similar to the characteristics of Fraser Centrepoint's current portfolio. So that means they are located near transportation nodes, and they are basically more necessity domestic spending. And the idea of acquiring this PGIM private fund is so that Frasers can eventually acquire these assets, so it will be injected into the Fraser Centrepoint portfolio. And these 5 assets, that there's a potential with the acquisition of the 5 assets, the mall footprint for FCT can potentially double. So for FCT, resilient spending as well as organic and inorganic growth potential. Next, for CapitaLand, we like them because they're building recurring income, as well as they're very focused at unlocking value. We can see that actually their recurring income stream is growing. So in FY19, recurring revenues actually contribute 1/3 of the revenue. Second of all, CapitaLand is very capital efficient. They have very disciplined asset recycling program. So they aim to divest about 3 billion worth of assets annually, and this will be channeled or funneled back into other assets to grow the revenue. They also are able to tap on external capital providers. So external capital providers are the REITs, business trusts, as well as the private vehicles. So in the graph on the left, you can see that the AUM of CapitaLand's private, AUM, the AUM of CapitaLand's fund management platform has actually grown with the acquisition of Ascendas Singbridge. The green color part of the graph actually shows the current AUM, and they target to grow the AUM to $100 billion. So this will actually increase their recurring fee revenue from this investment platform. Additionally, if you recall from the Escort slide, Escort, one of the lodging arm of CapitaLand is the Escort Limited. They also that arm is the one that generates recurring fee revenue from the management of these assets, and they also have a very aggressive or ambitious target to grow the number of keys under management by about 30% in the next 3-4 years. So additionally, we know CapitaLand to be a very strong retail mall operator, as well as they are very prominent in the commercial space. However, with the acquisition of Ascendas Singbridge, they have gained new geographies, for example, India, and also asset classes. So now with Ascendas REIT, they also have, and also Ascendas, they also have a lot of industrial assets. So they are able to grow this new geography, India, as well as the industrial assets portfolio. So that's it for CapitaLand, and I'll pass on to Jie-Hui for Yoma.
Thanks, Ned. Okay, next we have Yoma. We like that Yoma is entrenched in Myanmar's fast-growing and attractive consumer segments, namely in the mobile finance, property, consumer, and the automobile segments. In the property segment, it has a large property land bank equivalent to 10 to 15 years of sale. The projects in the pipeline to monetize this land bank includes the up-and-coming Yoma Central that is due in FY21, Star City, as well as the Peninsula Yangon. Financial services are also poised for growth through its key driver, Wave Money. It's the key jewel for Yoma. So just a bit of background, Wave Money became profitable within 2 years of inception, with revenue up by 5 times year on year and 16% quarter on quarter just last quarter. So as you can see from the chart on the left, Wave Money's transaction volume grew at a CAGR of 65% since 1Q17, and this is attributable to its brand leadership and large network of Wave agents in Myanmar. Better yet, Yoma actually recently announced an increase in stakeholdings to become a controlling shareholder in Myanmar. Controlling shareholder in Wave Money. This creates opportunities for Yoma to integrate Wave into its existing property and consumer business lines. Next slide, please. Its growth in the F&B segment is also underpinned by a 60% growth in KFC over the next 3 years. And this is just on store openings alone, excluding organic growth. Yoma is also expecting the number of KFC stores to increase from the current 45 to 75 stores should Myanmar's economy recover. So if you can see for the chart on the left, the total number of F&B stores is to grow from the current 91 stores to 125 stores within 3 years with the growth of KFC. Lastly, we find current valuations depressed in view of structural growth. Financial services and F&B will be the main growth drivers for Yoma. Our SOTP divided target price of 46 cents includes a conglomerate discount of 20%. So next, I'll pass on my time to Paul.
Thanks, Jie-Hui, for that. So we'll just run through the last few companies. Okay, next one is Asian Pay TV. We call it Mr. Unpopular because they cut dividends the past 3 years, and I know probably a few of you will be leaving the webinar now. But anyway, we hope that you will still stay on. The reason why it's been unpopular is, as you can see from the red bar here, which is dividends. So the last 3 years dividends have fallen. What has happened is that, okay, a bit of background. Asian Pay TV is the monopoly fiber provider, fiber provider for cable TV. So it's like your StarHub equivalent, but a lot of people use this to watch their local TV. It's not so much for foreign content. Okay, so what the reason why they cut dividends is, you can see from the red bar, this is the amount of dividends they paid. So in 2014, Yahoo, they paid 140 million, but the problem was the amount of free cash flow they actually collected was only 30. But I think investors still accepted the stock because they were still willing to gear up and the yields were high. So the problem happened then the last 2 years when it was no longer sustainable. You can see that in 2019, they cut the capex drastically to make the dividends more sustainable. So this red bar is the dividends, which they are now paying less than 20 million, and the free cash flow now is about 40. And we think that the dividends will become more. So the two reasons why we're positive is that the dividends will become more sustainable. So they are looking about 50 million free cash flow against a dividend about 18 million. So this is more sustainable. Okay, and a bit of background. The reason why what has happened is that the problem was this beige line. So they spent a lot on capex, almost 100 million in 2016, 2017, because the government wanted them to provide an extra set-top box. So every home suddenly there's a new additional set-top box for them. But the problem was that there was no extra revenue generated by spending 100 million one year and another around 80 another year. So that's why they got hit by this extra capex. That's why the gearing shot up, and that's why they needed to make the revenue more sustainable. So reason one now is that the 7% or almost 8% yield we think is more sustainable now, as you can see from the free cash flow. The second reason is that there's an optionality. What we mean is that they are still spending on capex is because they're preparing for 5G. So once 5G is rolled out in Taiwan, obviously it's going to need a lot of data backhaul. That means all the telcos need to connect all their base stations. The data will be more intense. So the operators won't want to build their own backhaul, their own fiber connection. They want to tap on them, which they already have the fiber and they already want to spend. And the good thing about this is this is going to be very high margin because you already spend all the capex. So if you sell the services, is the extra cost to pull a line is hardly anything. So that's why it will be going to be high margin for them. But the thing is the timing of this, they've not disclosed the timing. It could be the next 1 or 2 years. So we can't like pinpoint to you like which month or which quarter. But the thing is that you got this optionality and you got a 7% yield while you wait for this thing to happen. So that's the reason. So we hope you don't leave the room because of this. But anyway, anyway, we have a buy target and our target price is about 15 cents. Okay, I will move on to the next. So the next is Netlink Trust. I think we've spoken about this many times. So this stock is basically if you want a 5% yield and you don't want to think so hard about the stock market like us, we have to think how the market going to move every month and every year, then of course longer term trends. But if you just want something that earns you 5%, then this is the stock. The reason is that, of course, they are a monopoly. As we all know, all of us even for all of us use Netlink Trust. We don't see it, but we actually, when we pay Singtel the broadband bills, actually part of it goes to Netlink. So, and also everyone also forgets that their returns are protected. So for when at 100 million they spend, for example, they are protected, the IRR of 7%. So they're protected so that the government at least ensure that you get a reasonable return when you invest in the fiber. And the other good thing is that it's very stable because every month they collect 1380 and they get almost 236 million from the 1.4 million houses that pay every month. The only thing they have to make sure is just that Singtel and StarHub make sure they pay on time. That's all you have to do. I mean, I'm just exaggerating it, obviously, but you can get the sense that they don't have to do much for this. Not say they don't have to do much, but they're going to collect this 236 million annually, and it's very recurrent. Impact on COVID is hardly anything, and there will still be growth, but you can see from the chart, the growth won't be robust as in the past because everyone's home is already connected. As you can see, last year they had a big jump of 100,000 because StarHub disabled. As we all know, there's no longer any cable connection or fiber. So it will just grow by 25,000, so it's still stable. And there's a yield and our target price about 103. So if you want stability, you don't think so hard, and you just don't get the 5% yield, then this is the stock for you. Okay, next is PopNext. So we like it because it's one of the best financial metrics, but the issue is going to be cyclical. So when you hold there, might have to ride it out. Okay, but anyway, the first bullet point, it is the largest and they are dominant. So we know very few industry in Singapore where you got like 50% market share in any business. And then when you add up with ERA, I think when you do any new launch, ERA and then probably control maybe 70-80% of all the new launches. I'm just pulling a number. It may not be every launch, but just roughly. Okay, but the issue right now is that the results will be affected. As you can see from the chart, the red line, because of the circuit breaker, the number of units, I mean, this is you can see from the number here, second quarter total transactions, which is like resale and new launch, total transaction was 741 per month. Last year was 1,006. So obviously the circuit breaker will impact them. I don't think anybody wants to buy a house online. And so as a result, the impact, you'll see a weak numbers in the fourth quarter. First quarter was really good, was up almost 2 times the earnings, but you will get, the problem is that you will get this cyclicality, but we still like this stock. The reasons for, because they got really good financial metrics. The ROE is about 24, and this is, again, it's not geared. There's almost, they have like a 90 million net cash, and we think the yield can sustain at current level, probably about 6.7. The reason is that to keep this 6.7 dividend yield, they have to pay every year 13 million, and they have like 90 million cash. So you can do the math. So even if the next few years they hardly earn anything, they can still sustain this yield. And I think management has kind of indicated quite clearly they want the company to be a dividend yield stock. So we think the yield is good, and very few companies that you know that they don't need much capital. Their fixed asset, like we always, I mean, sorry if you hear this many times, the fixed asset is only 3 million. It's probably like two Mercedes-Benz and 5 computers, and that's all they need. I'm just exaggerating again, but you get what I mean, that they don't really need much fixed assets. Most of the working capital is in trade debtors, because they have to wait for the developer to pay. But again, they offset it against, they can just hold back, and when they collect money, they will pay the agents. So that's why we like it, because of the dominant market share and the attractive financial metrics. Okay, let me move on to the last two. Thai beverage. Okay, this one's a bit harder to push, because in near term, there's this third bullet point. There's a 3-week alcohol ban. Initially, we didn't take it seriously. I mean, like alcohol ban, right? I mean, like who actually forced? But actually, it really did happen. They really did enforce it strictly, and we can see from the numbers. April, the sales from alcohol dropped 50%. It did recover in May, so that's a positive. So the reason why we like it is that it's a dominant. So we just like the model is dominant. Although there'll be a near-term impact, but you cannot remove this dominance. They really control the whole market, and all the point of sales. They actually have a huge penetration and distribution network. Okay, the more longer-term problem for them is the Sabeco. As you know, they acquired Sabeco, Vietnam, the largest beer operator in Vietnam. But one thing has changed. The fundamentally something problematic has happened. That there's a decree. That whereby they're actually enforcing more driving penalties. So that kind of hurt consumption in all the bars and so forth. So this one will take a few quarters to recover, and also there's advertising limits. So Sabeco is the issue, but the good thing is that 90% of the earnings always comes from this partner. So that's why we still like it, and the valuations are at 14 times for consumer. Consumer usually trade about 20 plus times PE, and this 14 times is on COVID-19 depressed earnings. I know you got a ban, right? So I mean, like you probably lost 1 month of sales, so the earnings are depressed, and you're getting about mid-teens. So that's why we have a buy rating. Okay, last one for me before we move to questions is venture. Again, okay, near term we are still a bit worried, because what we do is that we monitor electronic exports out of Malaysia. As you know, venture, most of their production facilities in Johor, but the exports, I think we are just worried a bit on the disruption. As you know, Malaysia had an MCO, mandatory the movement control. So some of the plants were shut down. So there could be a bit of the second quarter might still be a little bit weak, not because of demand, but just the supply disruption. But the key reasons why we still favor them, as we mentioned earlier, technology spending is still resilient. And the first bullet point is that there is a lot of shift. Okay, we can see quite clearly the supply chain is moving from China into Southeast Asia, and especially into Malaysia, and especially Vietnam. And it's still paying a 4% yield, and they have 800 million of cash. So I think this year is going to be defended. And the ROE is attractive, and they are taking share from the global manufacturer. So just that in the very, very near term, the upcoming second quarter results, we're just a bit worried based on this, looking at the export numbers coming out of Malaysia, that the disruption will spill over. Okay, so that is our last slide. Just to conclude, I know, like we always say, most of you can't remember what we said when we understand why. So just to give you some conclusions. The recovery we think will be gradual, but the good thing about having a gradual recovery is that the aggressive easing by the authorities won't ease. So if the recovery is very sharp, then all of us will be talking when will the Federal Reserve kind of raise rates and tighten the monetary conditions. So when you have a gradual recovery, you almost painting quite a perfect scenario for equities where you gradual, then you have to keep it loose, and the fiscally they have to keep on spending until they see a sharper rebound. Okay, then the rest I think is quite, this is our target, this is a 12-month target, and the fourth bullet point, just that our equity strategy will be centered around dividend yield. I think no choice, I think the yield will become more and more valuable as interest rates remain lower. Okay, I think we can take questions. This is our research equity team. If you got any questions, just email this few, this 1, 2, 3, 4, 5. Okay, any questions, this 5. Then we move on. We have this is, if you want to subscribe to our WhatsApp, just put into this number, then we can send you our research report. All our research is here, stocks B and B. And again, if you have more questions, we have a community page. Okay, the trick of the community page is that you send us an email, we can tell you we didn't actually receive it, but when you send it through the community page, we cannot avoid, we actually have to answer you. Okay, let's skip that. Okay, let's move on to Q&A. We will move on to Q&A. I will stop sharing the screen right now. Okay, I think we got like 100 over questions. I'm not sure how we can cover most, but I will just take it in chronological. I'm not sure how to. Okay, there's still a lot of questions. We take it from the ones at the very, very bottom. Okay, sorry. Please share the WhatsApp number in barcode again. Okay. Okay, let me take that back again. Sorry for that if I did it too fast. Apologize for that. Okay. Okay. This is the WhatsApp. I'm so sorry. I overshot it a bit. Yeah. I'll leave this on. Yeah. Okay. Okay. We got quite a number of questions. Capital land dividend. Natalie, you want to answer that?
Sorry. Wait, I
think those are the very bottom. I thought that is that the latest, or should we take the ones at the top? Okay, sorry, we just move on to those at the top. Okay. Okay, any of the questions is how does Escort REIT compare against CDL Hospitality and Far East Hospitality Trust? FEHT seems more defensive, or CDL Hospitality Trust has better upside and as a higher beta play.
In terms of our preference within the hospitality sector, we like Escort the most because it is the most diversified geographically, and we feel that for hospitality sector, there's quite a bit of variable income from management contracts. So, the diversified, the stable kind of REITs are the ones that will be able to provide more stable dividends. In terms of with respect to the different geographies. Sometimes we saw this for Escort, especially in 2019, where most of the Singapore listed hospitality REITs are very Singapore focused. Even CDL has about 80% exposure to the Singapore market. So therefore, 2019 was not one of the years with the most events in Singapore, and therefore weaker revenues. However, Escort still maintain a relatively stable DPU because of the geographical diversification. Yeah, so in terms of hospitality sector, Escort, or rather diversified BU plays will be our focus. So I hope that answers your question.
Okay, I will move on to the next. For Asian Pay TV, what do you expect backhauls percentage revenue contribution to be in a few years' time? Can you offset the decline in subs and ARPU as core business? Is there any corporate action angle with either Foxconn or Dada Digital? Also, any potential hidden regulatory risk? Okay, quite a number of questions. Thank you for the question. Okay, in terms of percentage, I tried my best. Okay, I wing and hing, call him brother, everything. I tried. I mean, a very technical way to get the answer, but they only can say it's material. So I really can't. I tried also looking and a lot of look at other telcos. So there isn't much information out there, but we think for them to say material, it could be at least 5 to 10%. Okay, will it offset the subs and decline in subs? I think it can more than upset, because the margins for this will be much higher. It's almost pure margins. I mean, if you think about it, because they don't have to spend much, so the margins we think will be high. Is there any corporate angle? As you know, Foxconn no longer control the Data Digital. I think because they just want to combine all their network and sell all the backhaul as a package, from what I understand, because Data Digital also has other cables, so they want to join forces and then just go approach and tell you, okay, I can sell backhaul nationwide for you. Take it or leave it. Okay, not take it or leave it, but they can. It's probably a stronger value proposition. Is there any regulatory risk? Always, we think it will be less, but we can never be certain. I guess when it comes nearer to an election year, luckily it's already over. You always worry that some politician might pick up and say that, oh, the rates are too high, subscriber. That one are really hard for me to answer, like purely that there is no regulatory. There is always there can always be some regulatory risk, especially if they approach some election year. Then the authorities might say that, oh, you need to lower down, and they might use this as an election tool. But already the rates are already very low. I think every month you just pay, I think $15 or something. So it's already at very low levels, and the regulatory authorities already push them for second. So there is a risk, but I don't think it is that high. Yeah. Oh, okay. Next one, for NetLink, when will the results of the next regulatory reset period be likely be known? How do you see the risk of reduced regulated returns with low interest rate environment? I think actually I should know this, but I think the date should be 2023, if I'm not mistaken. Okay, I need to double check. I mean, the analyst should know this, but I think it's 2023. The risk, I think it's almost confirmed. I mean, if their WACC was 7 and interest rates dropped so much, we can expect the rates to reduce. But always remember that whatever they are spending now is already protected by the 7. So it will still, so there is a risk. I mean, there is definitely, but I don't think their yield will be affected. But just that the regulatory release for future spending that they do, that will be affected by the lower rates, because interest rates come down. You can't tell the authorities, oh, my cost of capital is still low, right? So there will be a risk, but it will be for the future spending. It won't affect them for the current capex that they've already spent, because that was during the prior regulatory regime. Okay, I'll move on to the next. How do you see the valuation gap and risk reward between FCT and CMT and other retail REITs? Is there a risk of rotation out from FCT to other retail REITs over time? Natalie, yeah.
Sorry, hi. Okay, so for FCT and CMT, we actually do cover these two REITs. Both of them are still quite attractive to us. However, I'll pick for this portfolio is actually FCT, because as I mentioned, I think you know, stable dividends and revenues are our priority here, and also not to mention that their growth catalyst is undeniable. Just in 2019, Fraser Centrepoint Trust, along with their sponsor, which is Fraser's Property Limited, they were taking stakes in the PGIM Asia Real Estate Fund, the retail mall fund, and they are very close to actually being able to inject these PGIM assets into their portfolio, which will mean organic growth, and especially in this low interest rate environment, that will be more accretive. So I think that's the reason for our focus on FCT versus over CMT. CMT, of course, you know, they are retail veterans here, and they have been very proactive in embracing e-commerce, as well as, you know, really industry leaders here. Yeah, and of course we do feel that this will help them positively moving forward. Yeah, and okay, so is there a rotation out from CFT to other REITs? Retail REITs over time? I would not say so, and especially because, like I mentioned, those people who, those analysts or investors who actually know about this potential catalyst, which is the acquisition of the PGIM assets, they will stay on to actually try to capitalize, or, you know, cash in on this catalyst. Yeah, thank you.
Okay, the next, again, thanks for all your questions, and these are very good questions that we are getting. Again, another good one. If one wants to play the property market recovery, why choose PropNext over Apex Realty or over CDR? Okay, I think if you want to, for property recovery, if you want that extra kicker, the higher beta, I think would be the developers. I think because you're going to get additional flows. I think when you play PropNext, no foreigners are not going to play PropNext or even Apex Realty because it is the beta is I mean the market cap is so small. So if I'm just arguing if suddenly there is a relaxation of property rules, I'm pretty sure CDR will probably run faster than PropNext. Because you're going to get additional flows from the foreigners. But no, PropNext is probably more local, but the reason why we like PropNext is more stable because the yield is a lower beta, more stable, and it's an income generating way to play the property market. Yeah, I probably that's the best I can. I hope that helps you. Yeah. Okay, move on to the next one. Is it fair to say that with cooling measures, Singapore property developers can't make super normal returns anymore? And valuations are unlikely to return to historic mean or peak levels. Natalie, you want to take that?
Oh, hi. Like previously mentioned, like we do see that for 2020, we do expect a price index to actually fall by about 5%. But in the following years, to 2021 onwards, we do expect. I mean, a bit risky to say also, but we do expect that actually prices should be able to maintain the current levels. And definitely in terms of supernormal returns, no, we will not be seeing that. But more marginal, sustainable kind of growth can be expected. Yeah, so when I say sustainable growth, it's probably around the 5% region, 5-10% region. Yeah.
Okay, I'll move on to the next. For Thai beverage, Vietnam business has been weak due to drink driving laws and fake news. Could that drag down the Thai business recovery? Also, the company said recently it is not selling Vietnam business. What does it mean for the investment thesis? Okay, it won't drag the Thai business because those laws are mainly in Vietnam. And whether they're not selling the business, I think if they sell the business, short term will be really good because the Vietnam business, the interest, I can't recall the exact number, but it is in the tens of millions in terms of the interest expense to hold on to this Sabeco because they took on a lot of debt to acquire Sabeco, this Vietnam business. So near term, maybe the market might rejoice because they suddenly the earnings will just shoot up because they don't have to pay the interest and their gear. But longer term, it is still a great business to own. I think these guys they paid because these are like once in a lifetime opportunity to get a beer business. They got like 40 or more market share in Vietnam. So it doesn't really hurt my thesis, but I think the Sabeco will give them the longer term growth angle because they need to turn around Sabeco, which will take some time. But it's hard to find any business that has 40% market share in beer. So yeah, I hope it answers. It doesn't really hurt my thesis. Yeah. Okay. The next question. What do you think about mini venture Franken? Okay. Bull say Franken has longer term growth coffee and more open in terms of disclosures. Okay, I don't cover Franken, sorry, but I know they're more in semiconductors, so not fair for me to comment. I apologize, I don't really have the answer for you. But in terms of disclosure, yeah, I think many people have probably more better disclosure than venture because shouldn't say this, but if you go to a venture briefing, the general view is just that the general comment is just that believe in me and don't ask so much questions. Okay, I need to move on. I hope they don't kick me out the next meeting. Okay, the next one, I think this will be for Chen Hui. I'll just read it out. For Yoma Strategic, a large part of your sum of the parts valuation comes from the value of properties in Myanmar as recorded in the books. Have you assessed if the cap rates or assumptions that go into the property market value are reasonable considering the lack of market data on Myanmar property transactions?
Okay, so regarding that, right, I think as you can see from the SOTP valuation, like most of the bulk of it actually come from that of the land bank, which is actually recorded at cost on balance sheet. So like the company actually provided us like the amount of land bank they have, and then like the range of the prices they can actually get from like the land bank itself. And then so we actually had a pretty, I wouldn't say conservative as well, because like for some of the estates, for example, like the Punhang estate, it's actually a premium estate where like it's able to garner, it's able to actually be able to sell at high prices. So like yeah, as in, apart from it being at cost on balance sheet, we also actually have a conglomerate discount of 20% that has been applied. So in a sense, I think that the valuation should actually be quite okay, I guess, like conservative in a way. And then some other questions below, I shall just read it out. So they with money, sorry. So with money, actually has a close competitor, KBZ Bank, and then it said that it has a wider distribution network than Wave. And then is it a winner takes all situation, or are there risks? So regarding that, right, KBZ Pay, yes, it's one of the larger competitors of Wave Money. And then I guess maybe I can elaborate how it works. So like for bank owned mobile money like KBZ Pay, KBZ Bank, how it works is actually that they actually have to go to their ATMs to access money, to cash in, cash out and stuff. And then in terms of the distribution network they have 414 branches and 514 ATMs. So in total, maybe about 1,000 network areas. But then this is actually in stark contrast with that of Wave's agent network, because if Wave Money actually has 57,000 agents across that of Myanmar, which yeah, it will be 57 times bigger than that of KBZ's bank network. Yeah, so and then in addition to that, Wave Money actually has 90 to 95% market share in the OTC business. Yeah, so I would think that Wave Money actually still has an edge over that of KBZ Bank. And then one last question here would be, is there a risk of Yoma doing further capital raising with the share price on the rise, looking at its past history? So very recently, Yoma actually had a recent placement with Ayala. Ayala actually invested about 20% into Ayala actually invested for a 20% stake in Yoma. And then with regards to that, right, they actually they actually utilize most of the proceeds into the real estate business, and then and then into other investments like the consumer, the automobiles, and the fund management business. With actually some of the placement proceeds unutilized, like 15 million of it. So I think in the short term, I wouldn't be expecting any more capital raising. Yeah, as in just in the short term. That's all from me.
Okay, thanks, Sherry. So we move on to the next question. If one has a longer investment, if one has a longer investment horizon, what are the COVID recovery plays that has the most upside in the medium term? Because everyone has different sectors, so from those that I cover, I think the rest just take your own banks or property. Probably, I would think electronics would be the one. I think the reason I say that is there's probably a good runway for electronics. Okay, only those that are in, maybe you have a plant in China, like someone like Veritronics, they got plant in China, so that one will take longer because they are almost half their sales is hit by the duties, by the tariffs. But apart from that, I think electronics probably have a good runway the next 1 to 2 years, because after this you're going to have 5G capex coming in, so there's a good growth trajectory. From those that I cover, I'm just thinking medium term. Electronics or the tech sector is probably the one that I probably see. How about you, Natalie and Wee Kwang?
Hi, for the banking sector, I think in the near term, a lot of people are asking whether now is a good time to buy, considering that our target prices, as in the current prices are probably slightly higher or even similar to current our target prices. I think that right now, if you're entering into the banks, you're definitely not looking for a capital appreciation, and instead looking at the yield, how attractive it is, because compared to regional peers, which are having a yield of maybe 4%, 5%, the local banks are actually having a yield of about 5 to 6%, which is much more attractive. And when we look at moving into 2021, 2022, when we are likely to see the economy starting to recover, the financial system will definitely stand to benefit the most out of it. So that is probably 1 or 2 years down the road. So our advice for them, if you are looking to enter, hold for the yield in the short term, and then over the long term, definitely it is poised for growth after the economy starts to recover.
Okay, we really hit 12, and I don't want to take up too much of your lunchtime. We just take the last three. It's all mine. I think I'm covering too many stocks. But anyway, what is the future outlook for SPH after dropping out of the STI? I think I kind of have a bit of a soft spot for SPH. Okay, once you drop off the STI index, you know there's a lot of natural sellers. That means people who just sell not because they don't think the outlook, but because it's out of the index. So a lot of passive money, there will be some captive selling. So you know there's a bit of overselling on STI. The interesting part for me is not the media, not the print business. Obviously, we all know that. But the interesting part for me is that they've got a lot of hidden assets, or they've got a lot of hidden properties that are not really well valued. So there's a lot of value inside their properties, and also the weakness in the student dorm may not be that as severe as everyone thinks. And thirdly, they could come up with the IPO for the student dorm. So SPH looks interesting, just that we don't cover, so we try not to give a view, but there is some positive offsets, and I always like to buy something that already been like oversold, right? Because it's out of the index. Okay, the next one, second last question. Why are you neutral on Comfort Delgro? It benefits from if it benefits from phase 2 opening and has been diversifying to reduce over reliance on domestic and operations. We just use valuations, I think, and also, I mean, to be fair, to put something on it really dropped a lot. So it's more on valuations, and also phase 2 there could be some improved performance based on news flow, but fundamentally structured longer term wise, we are still a bit negative on it. Diversifying, no, I don't think they're still heavily relying on taxi. I don't think there's much diversification. Going overseas though doesn't really guarantee better returns. Yeah, because the taxi is really the jewel. Because you don't take passenger risk, right? You just collect rent every month. Whether you got 2 passengers, 1 passenger, you still got the rent from the taxi drivers. Okay, any last question? Again, all your questions again just put in. We have a community page here. You can either email the other analysts or put your questions on the community page. We will try to answer them. Last one, if you take a 3-year view, what are the risks that sets at the current price won't deliver a decent return? Okay, the big worry for me on sets is that, of course, when volumes pick up, the business should improve. My worry is SIA. They never disclose the number, but I can just assume maybe 40% roughly, or even 50 of their business comes from SIA. And and when your customer is hurting, I can believe you, the customer is going to press on them. So you worry that SIA is just going to press down on all the food that they get from sets, all the services that you get. So it's not only just the volumes. We are very worried the pricing for sets will get pressed down by SIA. Because all the customers are just are performing so badly, and liquidity wise, financially. So I don't think sets is going to ask, like, can you give me better price? They're probably going to press sets on the pricing. Yeah. So I think we've come to the end already, 12:05, because there's another one in 12:30. I know we missed a lot of questions, so really sorry. We thank you for all your questions. Again, you can just post it in our community page, and we will try our best to answer, and we'll pass it back to Kosin or Kimberly. And again, thank you very much for your participation and staying with us for that 2 hours. I know there are better things, nicer YouTube channels to watch for 2 hours. But thanks again, everyone, for spending time with us and all your questions. And again, any questions, just you can post it out in our community page. Thank you.